So we've had a few questions the last couple of weeks about losses when we're investing. I had a call with Henry, who's Lawrence's brother, who can't be here today, unfortunately. And he was asking a lot of questions that actually we realized we haven't covered and maybe seem quite intuitive to us after years dealing with investing and finances, but are maybe not that straightforward when you're getting started. So we're going to cover them now. Losses are not fun to talk about. Let's get that out of the way. No one likes to admit when they've not done well. No one likes to admit mistakes they've made, but it's really important that we do. We don't want to pretend that we're perfect. No one is perfect. Warren Buffett is not perfect. And as Chris said in his psychology talk last time, the losses when we make mistakes is actually where we can learn the most about what we need to improve. You know, maybe you've got confused. Maybe you thought you've heard the old saying, buy low, sell high, and got it mixed up and did it the wrong way around. Maybe you're like Cami and you've bought into weed stocks because you like a good smoke and you've gotten that a bit gone the wrong way. Or maybe you just like to go on Wall Street bets and see people YOLO away life-changing amounts of money. You know, here's one of 150K in 3 months, and that's not even a big loss for people on Wall Street bets. But whatever the way is, you will have seen losses, and it's important to learn to manage them. Before we talk about investing losses, let's talk about what happens when we buy something. Let's say we start with £100 in our account. You know, that maybe is not a lot of money, but it's enough to see what we're talking about here. You've got £100, but you don't have pants. And for Chris, that's a real problem because he doesn't wear anything underneath his pants. He just wears his outer trousers. So he's got to cover up. He finds a designer that he really likes. It's not a very well-known designer, but it's someone he thinks will do well in the future. So he buys some jeans from this designer. He's now got £50 in his account, and he values those jeans at £70. He thinks the designer is going to be worth more in the future. He's just not well-known enough now. So he actually thinks he's got a steal on that deal. You know, he's paid 50 and he thinks it's worth 70. And now he can cover up and go out in public and go and do his shopping and whatnot. His girlfriend's not embarrassed by him, or at least not for that reason. Now, say the next day after you buy it, someone comes along and offers you £25 for those jeans. Well, Chris would be insane to panic and sell them back to him for £25. He just paid 50 and he thinks they're worth 70. So just because someone's offering to buy them for £25 doesn't mean that he's going to sell them. So he says, no, like, I'm happy with my jeans, go away. And he's left with still £50 in his account and his ownership of these jeans that he believes are worth £70. Now, say a few years go on and that designer is now much more famous and his clothing is worth more than it used to be. Someone comes along to Chris and says, hey, I'll pay you £75 for those jeans now. Chris is quite pleased with that. He thinks these jeans are worth 70, so he's getting he's getting offered more than he thinks they're worth, and it's a profit on what he initially bought them for. So Chris sells him the jeans. He no longer has ownership of those jeans, but he does have the £75 back in his account. Chris goes away once again pantless, looking for some new designer that he can exploit for more money. He's got profit in his account, and this institutional investor here has got his ownership of jeans. Something very similar happens with investing. We take money from our account and we exchange it for ownership in a corporation. Now, in our strategy, we look for a massive bargain. We want to be spending £50 on a share that we think is worth 125, for example. That is a massive bargain to us. And that means that when someone comes the next day and offers us £10 for our shares, which is what the market price is essentially, it's the price people are willing to take your shares off you, we don't panic. Just because someone's offering to pay less than we paid for it doesn't mean that we should sell it. We think we've got value in a company that's worth £125. There's no way we'd sell that for 10. You wouldn't do it for jeans, and so you shouldn't do it with your shares. If you did, you would lose that ownership in the company and only get the £10 back in your account. And there is your loss. You've panicked, you've sold it for less than you think it's worth, and now you've realized a loss of £40 on your initial account value. But say you don't do that, you just hold your share of ownership until someone comes along and is willing to pay you what you think is more than a fair value for your share. In this case, say the guy came back and was willing to pay you 150. Maybe you say, it's been great, Starbucks, I've enjoyed owning you, but I'm willing to give you up to this guy in exchange for the money. Now that's all very straightforward and sounds simple, but it's important to note that emotions play a huge part in this. You know, if any of you have opened an investing account recently, you might have seen, if any of your investments have gone down in value, a big red number next to it. And it looks like a decrease in your account value. But it's important to remember that that decrease is not real. It's only real if you panic and sell to the people who want to pay less. So how do we actually manage those investing losses, quote unquote? First thing to do is go, why on earth are people selling this? Are people trying to buy this for even less than I paid for it? Has something happened? Was I wrong? You need to go and analyze your analysis. You need to go back over, you need to double check everything, triple check everything, see if some news has come out, see if anything has changed about the company. You know, if you bought something because you think it's worth 200 and people are buying it for 10, you know, they could all be wrong, or maybe you're wrong. And it's just worth double checking all your figures. But let's say nothing has changed about the company. The price has dropped because someone like Elon Musk has tweeted about his own share price being too high. Well, nothing has changed about the company. You know, maybe it was too high before and maybe it's too high after, but it's him tweeting that hasn't changed the fundamentals of the company. If you've invested in it, you hopefully have bought it at a price you think is acceptable, and his opinion shouldn't matter too much in this case. Assuming that we've decided, you know, this is just a random temporary fluctuation in the market, it's just news, it doesn't affect the fundamentals of the company, we should be happy about the fact that the price has dropped. We should be excited, because what it means is we can buy more of this company at an even cheaper price than what it's worth. That's quite exciting. You know, if someone's offering you £10, if someone's offering you to buy a share for £50, and you think that's great, and then the next day they say, do you want another one for 25? You're not going to be annoyed that you bought one for 50 the day before. You're just going to be excited that you can buy one for 25 today. Now, one of the things we also have to talk about with investing is that a missed gain is not the same as a loss. Okay. Now, there's been some discussion between myself and other people in the group about, well, our strategy shows that that companies like, say, Tesla or say big growth companies are not good companies to invest in, but you know, they do massively well in the stock price. You can make massive gains by investing them. The key thing about our strategy is that we don't want to lose money. That's the rule one about investing, is don't lose money, because it takes so much more to gain back a loss. You could have, say, invested in this company back in 1996 in Monster Energy for 1 cent, and it would be now worth 900,000% more than it was at that time. And it's maybe you look at it and go, well, if we'd looked at the numbers back in 1996, our strategy would have said probably not. Like, it's not a great company, we don't know where it's going, we can't predict its future. And it seems easy now to say, oh, well, you're missing out on massive returns. But the key thing is, it would also protect you from companies like MicroStrategy, which we talked about during the dot-com bubble. It went all the way up to $3,130 and then crashed down to basically nothing. It lost 99.99999 something percent of its value. If you had all your money in that, you were wiped out and starting from scratch. It's sometimes fun to speculate on some of these wilder stocks, things like Tesla, things like MicroStrategy back in the day, but you should always do it with a small section of your portfolio and stick to a safe long-term investing strategy for the rest. I just want to also remind you with all of this, it happens to the best of us. We all make mistakes. We all get caught up in emotion. We don't make the correct analysis, whatever it might be. Warren Buffett is known as one of the greatest investors ever in terms of long-term value investing. When he was 21, so about the age most of us are now, he made what was to become his greatest investment mistake ever. He invested $2,000 out of $10,000 of his net wealth in a gas station opposite a much bigger gas station at the other side of the road, and lost all of it. If you think about what Warren Buffett's worth nowadays, you're talking anywhere from $20 billion in terms of lost opportunity. And that's a big loss. I don't know about you guys, I've not lost 20 billion yet, and I hope to never lose 20 billion. Relax. If you've done your analysis correctly, don't worry about what the price of the market is doing. Just sit and wait until people realize the value of the company that you've invested in. Does anyone have any questions about that? Does any of that not make sense?